Hi everyone, welcome to the second panel of the conference today. The conference is held by the Levy Economics Institute. This panel is going to focus on the financial system and banks. The subject is how to build a stable financial system the central bankers use, so I'm surrounded by central bankers. My name is Viktoria Dendrinou. I'm a reporter for the Wall Street Journal in Brussels. I write mostly about banks, financial services, and financial regulation. This is a very topical subject. I mean, not that financial services and banks are not topical generally, but it's particularly topical now because it's been less than a month since we had the results of the EU stress test and the ECB asset quality review. So, I mean, policymakers and the wider public is in a much better position to understand what the state of health of the banks is and what the quality of their assets is. We're also sort of, at an EU sort of Eurozone level, a lot of milestones have been completed, like the key building blocks of the banking union are basically set up, or in the process of being set up. We've got a single resolution mechanism, a single supervisory mechanism that has been up and running for the last few weeks. And of course, we're coming to the end of this sort of era where we've seen a massive wave of regulation for banks to sort of make sure that they have stronger capital liquidity requirements so that the financial system will be able to better weather a future shock and shield itself a bit more than last time. And of course, it's a very sort of interesting time in terms of monetary policy. Interest rates are to a large extent at record lows. We've got Mr. Draghi saying that, the ECB is open to further easing if inflation remains too low for too long. So, I mean, these are all just sort of some reasons out of the many why this is a very important subject and a very interesting panel. So without further ado, I just want to introduce you to my speakers. To my right, we've got Marek, the governor of the Central Bank of Poland. To my left, we've got Mr. Patrick Honohan, the governor of the Central Bank of Ireland. And further to my left, Mr. Lubomír Lízal, who is the member of the board of the National Bank of the Czech Republic. So this is a great panel because we've got representatives from Eurozone and non-Eurozone countries, and we also have sort of, a wide range of experiences of different economies, different financial systems, different experiences from the crisis and exposures. So I don't want to keep you longer from hearing from them. First up, we've got Mr. Patrick Honohan.
Thanks very much, Victoria. And thanks to Levy Economics Institute for inviting me. I was delighted to get the invitation. I tried to come last year, but I was delighted to come on this occasion, not least because I was a reader of Minsky before, not only before this crisis, but before the last two crises. I went back to my PhD thesis. I said I must have cited Minsky in it, but somehow he didn't get into the citation list. But I remember reading those very strange articles and books about business cycles, which was the topic of my PhD thesis. Very difficult to understand, I have to say, but obviously it doesn't take me to confirm it. Insightful. What I wanted to talk about at this session really is an extension and fitting in very much to what was discussed in the previous session before lunch. I want to talk about financial engineering. I want to talk about monetary policy initiatives, and to some extent the seepage between the two, although one of the speakers emphasized the importance of keeping these issues separate, but they're not always kept separate. And provocatively, I put in my title, and politics, but of course, being a central banker, I don't talk about politics. But there is a political background to all of the policy developments and the policy prospects in the euro area. So slides are there. I apologize, they're not as tidy as I would like. Struggling with my iPad to revise them. They seem to go in a strange way, but let's hope they are legible. And this whole topic of financial engineering and monetary policy comes up again and again in the context of the euro area crisis. We've seen a whole series of proposals, some of them solid, some of them less so, and some of them actually implemented. Why did we need all these things? What is the nature of the crisis? It's this sequence of adverse developments which have beset the euro area. So these three interlinked but also separate problems that have arisen. First of all, the global financial crisis. And of course, financial engineering was very much implicated in the creation of the global financial crisis. But that's an old story, and we don't need to go back to that. Doesn't mean financial engineering of any type has to be shunned and avoided. But we do have to keep in mind that financial engineering is a two-edged sword. And then the euro area sovereign debt crisis, which would not have emerged as quickly or in as dramatic a way if it hadn't been for the global financial crisis, but it is a separate crisis. And now we're in the situation of the protracted period of below target inflation, which seems to be in prospect and which we need to get out of as quickly as possible. Now, the debt is at the heart of all of these crises, all of these elements. They're all about debt. And it's natural that we should think about monetary policy and financial engineering as potential solutions in this context. Why is debt important, especially in the euro area, and especially at this time? And I think, well, before I explain that, maybe I will show the next chart, which is just my favorite chart of stock taking on the crisis. And I look at employment. There are different ways of doing this, but I just like this chart. And the chart shows how far what the fall in the percentage employed is from the peak reached in 2007 in each of these countries. They're all European countries. And I'm sorry to say that Greece is on the extreme left-hand side, both for the blue and for the red. And what's that? The blue is peak to trough. Okay, so all of the countries are above the trough, even Greece, but the red is the peak to the latest figure. So we see a very, very steep, and I don't have to remind the audience here. And after that, there are Spain, there's Cyprus, there's Ireland, and some countries that you might not have thought of because there are secular things happening as well. This crisis has gone on so long that the long-term trends are important here as well. So you see Denmark is right up there as an economy which has a lower employment share in the population than it had before, and so forth. And then a number of countries on the right-hand side that have fully recovered in those terms. I prefer employment to GDP, particularly coming from my country where lots of distortions from multinational company location in Ireland. But also I think employment is really at the heart of the political environment in a variety of ways, both for good and for bad, as I'll mention. So this is the point I was going to make about debt being absolutely a central issue in Europe, and two reasons here. One is that official indebtedness has become very high, especially after the crisis. And because debt ratios are slow to fall, because of this low nominal GDP trend, real growth and inflation are both below the trend or below the target. So that's that complex of official indebtedness. And then not only is the debt high and not coming down in terms of ratio, but we have the other factor is that these are market nervousness, because there's a new environment in relation to debt because of the defaults, the Lehman default, we call it Iceland, with Greece we can mention. These have resulted in a reassessment of tail risks in the market. The market previously would have said, European sovereign default is a joke, it's not to be considered. Now, a big investment bank, so markets have evaluated those tail risks in a different way. And that means potentially higher, or actually higher debt servicing costs. And then there's another point. However, although this is a common problem and affecting every part of the euro area and every part of the European Union, let us say, the consequences of the debt overhang are more clearly perceived in some countries than in others. In some countries, the situation does not seem to be too bad, and that, I think, moderates the response that we see. I don't know if this chart is all that interesting, but this shows you total employment levels, and the index is 2007 equals 100. I could have taken 2008 equals 100, but anyway. And what you notice here is blue is Germany, and there's hardly any effect. So if your sole measure, and it isn't nobody's sole measure, but if your sole measure was employment, and you're sitting in, and I just take Germany, it's the biggest economy and the most successful through the crisis, you say, what crisis? You can't see it in employment figures. You can see it in every other section, including the USA, which is dipped steeply. That's the grey bar that dips steeply down. I think I can point, yes, I can, to there, but then comes up nice and smartly. So you can see why that might not seem like a serious problem in some places. But actually here employment is only a partial indicator, and if we look at GDP, we see a somewhat different story. The same colors are used, so we see the recovery. Where's my blue, my red? There it is. There's Germany, and we can see that the recovery of German GDP is strong, yes, for sure, and it's much stronger than the non-euro area, which is in green there, Japan down there, there's the euro area down there, but it's not as strong as in the USA. So in fact, even this debt crisis in Europe is affecting German growth as well as, that's not a proof, but I make up that as a proposition. Anyway, so what about the financial engineering initiatives that have been suggested? Some of them have actually been implemented. So there might be a tendency to think, oh, why aren't we doing anything? Well, a lot of things have actually been done. Monetary policy and financial engineering initiatives have been taken. First of all, let's acknowledge that there has been a major initiative in Europe in terms of leveraging in investments by the creditor countries in Europe into a new fund, the European Stability Mechanism, which has produced very substantial loans to stressed sovereigns, including Greece, my own country, and a number of other ones. There are negative nominal interest rates, a monetary policy initiative. Well, there's been huge debate over whether it would be safe and wise to have negative nominal interest rates. So now we have a policy rate in Europe, the deposit rate of the ECB, which is negative, it's minus 0.2, and that is actually trickling over into rates in the banking market. You see in yesterday's newspaper, one of the largest German banks will charge charge 0.2% to large balances of their big customers. This crosses a Rubicon which many people thought would not have been crossed. So I do want to stress that a number of things have been done that would have been considered quite radical a short while ago. The other, also in that dimension, has been the outright purchase by the ECB, and we'll come back to some of these things, of high yield assets. It purchased quite a lot of bonds from stressed sovereigns, including Greece. It bought covered bonds, that's safer business. And now, as in from right now, ECB is buying asset-backed securities, bundles of SME loans and residential mortgages. Just the senior tranches of these, not the riskier tranches. ECB is lending on a long-term secured basis, yes, but it is lending at a 4-year maturity now to banks, which would have been considered absolutely extraordinary if we turn the clock back to before the crisis. And then we have things like collective action clauses on all new sovereign debt. There are other initiatives that have been suggested which have either not been applied or not been fully applied or remain just as projects or have been more or less shelved without much interest. And there's Euro bonds in various flavors. I'll come back to those in a little bit. We heard another one from Professor Dendrinou this morning. Maybe that's not quite right to call it a Euro bond, but something in that area. There was a proposal a long time back, maybe 2011, maybe 2010, that a multinational fund like the ESM could be given a banking license and then could have access to refinancing from the ECB, huge leverage potential possible, but lots of political barriers to that and possibly legal barriers as well, but it was there in the background, simmering away. It hasn't been activated, doesn't look like being activated. I'll talk a little bit about GDP-linked bonds. people talked about that. I talked about that myself in 2010. Tail risk insurance. So the solution to all of these indebtedness problems has been more loans. Well, great, thanks very much, and it does help, but is that actually the best form of financial engineering to solve an over-indebtedness problem? Would it not be more sensible to link the repayments to some form of alternative risk sharing? There is a proposal for bailable bank bonds to have a new approach to the resolution of failing banks, so that explicitly bailable bonds, in other words, bonds that could be converted to equity or cancelled in the event of a bank nearing a situation of insolvency, but without it having to go through the process of a bankruptcy. Those are now legislated for in the bank resolution directives, the two directives, not really in place yet, but they will come. On the other hand, the idea of a multilateral entity like the ESM directly investing in bank equity, that was an idea which has been explicitly acknowledged as a possible, but it actually hasn't been activated, and that is something which could also have changed the risk structure, and I'll come back again to that. How could I come today and not mention quantitative easing? Central bank purchases of a targeted quantity of sovereign debt. Certainly that's something which is there and which could be activated at a certain moment. And then I should also mention President Juncker's very recent proposal, CDO proposal, to leverage up a certain amount of public sector injections to achieve a growth of infrastructure finance. So let me dig into just a couple of these in a little more detail. So monetary policy, is it, I'm tempted to sort of say, is it so bad? The ECB gets such a lot of criticism. Now, yes, we are below our target, and the forecasts are for not coming back to our target quickly enough. That does not, and here I would take exception or take a different tack to some of the discussion this morning. I think if central banks can't achieve a 2% inflation target, I'm not sure what they're for, and I'm sure that the central bank can achieve that and will achieve that. ECB interest rate policy and the forward guidance, they've kept long-term interest rates in the core countries of the Eurozone at record low levels, especially this year, really, really low levels. And so the monetary policy action has been very vigorous. And by the way, in as much as that lowers the servicing costs on sovereigns, it has an indirect benefit, and any other debtor, it has a side benefit of mitigating debt overhang problems, at least for the servicing costs and for the time being. But inflation has dipped below target. I just show you two slides there. One showing you where the short-term interest rates have gone, and you can see the dramatic fall. This goes from 1999. This is a whole period of the euro area, and you see sometimes it was high, sometimes it was low before the crisis, but since the crisis, this is not the policy rate, this is the short-term interbank rate, and even during those tense periods of 2010, 2011, of course, we can discuss the exact movements from month to month, particularly in 2011, but interest rates have been nominal interest rates have been exceptionally low. Of course, real interest rates haven't come down as much when inflation has been low as well. And there's the inflation rate through the history of the entire euro area, and you can see that surge in inflation just at the beginning, just before the crisis, to 4%, and then the collapse immediately afterwards. And then you can also see there in 2011, this is the headline inflation rate. It actually went up above 3%. We're so used to thinking of inflation as being terribly low now and below 0.5% even, but it's only in 2011 that it dipped below that 3% mark. Core inflation was much lower, but now we have it very low now. So something more, it seems, has to be done, and something more is being done. We've had a number of initiatives in the last few months. Let me speak a little bit about how to think about those initiatives. They're initiatives not now on interest rates. Interest rates are at the lowest level. We've said Now, some theoretician might say, oh, you've got the main policy rate is 5 basis points. Could you not make it 0 basis points? We've taken the view in the ECB and announced that this is it. This is the bottom. It doesn't go any lower as far as interest rates are concerned. So anything else that we do has to do with our balance sheet. So let's look at that. And I think it's important, the size of the balance sheet, the amount of liquidity in the system matters. That's the liabilities of the balance sheet. But the assets taken onto the balance sheet by the central bank. Whenever the central bank affects liquidity, it affects both sides of its balance sheet, but what type of assets it holds on its balance sheet are also important. So I'd like to emphasize that because there's a literature going back quite a long way on just how effective open market operations are, by the central bank are, if the asset acquired is highly liquid and with low credit risk. Highly short term. How much is achieved by acquiring a very, very short term government bond in return for liquidity? And there are various neutrality propositions in the technical literature suggesting that the benefit can be limited. And so that means you also have to look at the asset quality. What are you doing on your asset side if you are increasing the size of your balance sheet? So not only the amount, but also the what of quantitative easing matters. And you can basically do two things to oversimplify. You can acquire long-term assets or you can acquire risky assets. By taking long-term assets onto your balance sheet and out of the market, the ECB can create a relative scarcity of long-term assets and drive down long-term interest rates. By taking risky assets onto its balance sheet, likewise, the ECB can reduce the risk premium on risky assets. In the United States, their quantitative easing, well, they did a lot of things, but the big picture one, particularly in the last couple of years, has been to take out term. And that allowed them to achieve a lowering of long-term interest rates. There is some absorption of credit risk by the ECB in the covered bond program, in the ABS. Not much, but some. Some sovereign credit risk was taken in the SMP. There would be sovereign credit risk in the OMT program, which is a program that's there, but only to be used in certain circumstances. And the sovereign credit risk there to be managed through policy conditionality, a whole area that none of the other major central banks have to get involved in. The Bank of England doesn't say, oh, well, we buy some of your government paper, but listen here, government, you've got to do this and that and the other thing, and a memorandum of understanding and criteria, because the Bank of England is part of the British public sector, part of the British state. And with the multi-country situation of the euro area, you have a different situation, and that's why the OMT is such a complicated thing to design. So as you take out bits of credit risk and bits of term, are you going to affect the whole operation of financial markets, or are you only going to affect the spreads in the particular markets that you intervene in? So if you buy Portuguese paper, is that only going to affect Portuguese credit spreads, or will it spill over into similar markets? Textbooks would say it should spill over, but how much? How segmented are the markets? This is quite an important question. It's important particularly if you're thinking about QE, and if the ECB started to buy bonds, which countries would it have to buy to have an impact? Does it just not matter? Very simple. Textbooks would say you buy anything, buy toothpaste. You will provide the liquidity into the market and you will have the effects that you want. I think that's not right. I think markets are segmented, so I think you do have to think about what you buy and not just how much you buy. Well, I have a slide now on what the UK and Japan and so forth are doing, but I have the feeling that I'm running a little bit long, so I'll just skip over that and talk about some other, that was monetary policy. What about the other types of financial engineering initiatives? And as a general possibility, a proposition, I like to think of financial engineering as something that seeks to bundle or unbundle risks, for example, credit risks or maturity term risks, in order to transfer, or in order to enable the transfer of risks to those best placed to absorb them. Of course, it doesn't always work that and the crisis showed us that it's sometimes, financial engineering sometimes transferred risks from those smart enough to design them to those who not smart enough to understand them. That type of financial engineering one would try to avoid. But I would conjecture that a better transfer of risks in the euro area would have resulted already in a sizable overall gains of wealth, national wealth, in the euro area. And I'll suggest why in a minute. But we do have to have in mind the caveat that any attempt to transfer, well, sometimes the attempt to transfer risks to people at a reasonable price to people that are able to bear them better, it can be just an attempt to dress up a transfer of losses and debts. And that's the problem, the lack of confidence. If there's a lack of confidence in the market or in intergovernmental discussions where potential buyers of products that are transferring risk are just transferring debts. Let me take two examples of risk-sharing plans. Just two of the long list that I showed you earlier. Well, the whole question of direct capital injection into banks for example, by the ESM. A number of countries, banks were an issue also in Greece, but mainly tangled into government indebtedness. But in a number of countries, banks proved to be undercapitalized or insolvent in the height of the crisis. But the solution adopted was to lend money to governments for governments to inject the capital into the banks. So the bank risk was absorbed by the national government, which was not necessarily the government best placed to absorb that risk. Upside potential was missed by the lenders in this case. I give you an example of an American, North American investors into one of the large Irish banks. They invested $1 billion, €1 billion, I think, I can't remember whether it was dollars or euros they invested, into, at the height of the Irish banking crisis, at a moment when the ESM could also have invested that money, and they made a return 3 times, 300%. So there are missed opportunities simply in financial terms, not using fairly plain vanilla financial engineering to solve an over-indebtedness problem. Entirely different from banking. What about lending to governments on a GDP-linked basis instead of simply on a debt basis? I wrote about this in the Financial Times in the middle of our crisis in Ireland. And let me show you, let me see where, oh yes, let's skip ahead to this chart. This is a rather complicated chart. This is the one I would like to have drawn better if I didn't just have an iPad and squashed on a plane. And what it shows you is, it shows you the development of GDP in the countries that borrowed from the ESM since the crisis. It shows you what the GDP projection was expected to be at the moment that the program was negotiated. It was in the program document. And it shows you what the actual evolution was. Now, in the green case, which appropriately enough is Ireland, we see on average that the solid line, which is the actual development of GDP, was as good or better than projected in the program. So if instead of lending at interest, the loans to the Irish government had been GDP linked, chances are the lenders would have done better than with a fixed interest loan. And by and large, Ireland has done better than the other stressed countries, and Ireland could have absorbed that. It would have actually the development of GDP would have probably been even stronger because the Irish government would have only had this conditional indebtedness, not the absolute indebtedness that it actually incurred. In the other cases, and obviously not surprising to you, the blue line here is Greece, and the actual evolution is a much, much weaker evolution of GDP than was projected. And I hope those are the right numbers, but anyway, we know that the actual evolution was much, much worse. So in that case, the risk sharing that would have been involved in a GDP would have meant that the lenders would have absorbed more of the loss. But at a fair price, this would also have resulted in a better evolution overall of the Greek economy, would have reduced tensions in financial markets at that moment, and it would have generated an overall better outcome for Europe as a whole. So there are some missed opportunities there. Now, this is pretty crude presentation, and it would need to be done in a much more sophisticated way, but obviously there's a potential for better risk sharing in these kinds of transactions. Now, I'm doing very badly for time. I'm running very badly over time. There are many, many other risk-sharing financial engineering initiatives out there. There were very fashionable around 2010, 2011 plans for the mutualization of debt, and there was some discussion of mutualization of debt in the earlier session. All sorts of probably the most interesting ones are these four: the Debt Reduction Fund and Pact proposed by the German Committee of Council of Economic Experts. There's a Eurobills proposal. There's Philippon and co-authors. There's something called the SBs. That was the Brunner-Meyer Euronomics suggestion, was mentioned also this morning. There's the Padre plan. That's a somewhat radical central banking plan, V+ proposal. Well, I'm not going to go into the pluses and minuses of all of these. It's very amusing to see all the options that were rolled out. In fact, if I take the Debt Reduction Fund and the SBs, it's very curious because they were proposed within a few weeks of each other by highly respected experts, and one of them mutualizes all debt in Europe above 60% of GDP, and the other one mutualizes all debt in Europe below 60% of GDP. It just tells you the range of possibilities that are there, and the lack of yet a focused conclusion by analysts on which problems are the most important ones to solve. Each of these schemes has benefits. And the problem, however, is that although their proponents see them as Pareto improving schemes, good for everybody, that is not the way they are received by policymakers in different parts of the euro area. The envisaged benefits are seen as skewed towards certain countries. They probably are skewed towards certain countries. A Pareto improvement doesn't mean that everybody benefits by the same amount. But if there's a suspicion that they're not Pareto improving and there's an evident skewness towards debtor countries, then creditor countries may stand back and say, well, I think we're going to lose here. We like the general outline of the plan, but in the detail, we think we're going to lose. And I think that it's probably true that the risks of these plans are large. They might not work, and the more grandiose the plan, the more likely its adverse side effects would be. And for sure, there are moral hazard problems. I'm sorry to mention moral hazard, but it is a reality of life, and it's certainly an imagined reality, even more than the actual. And finally, we have the treaty, which prescribes, as was mentioned several times this morning, actions that would turn the euro area into a transfer union. That was a very strong theme in the development of the euro area. Whatever we do here, it's not going to be a transfer union. It was sold to electorates on that basis, and many of the people who sold it to the electorates do not want to go back on their word. So that is a huge, and that's the politics in my title. So that's my summary slide at the end. Why has there not been more use of financial engineering? There are contract credibility issues. I haven't mentioned them too much. I mentioned the layman's and the defaults. if contracts are not going to be adhered to, all of this financial engineering is useless. You say, oh, look, we have a financial engineering, this gives this benefit to that, and in that circumstance that will happen, and this circumstance this will happen. Well, if the contracts are not going to be adhered to, then that all goes up in smoke and you can forget about it. So all of this discussion about financial engineering and Eurobonds and all the rest of it has to be anchored in an environment where contracts are adhered to. I don't mean to say that restructuring of contracts is impossible, but I'm saying that there has to be an understood framework. We don't have sufficiently flexible institutional and legal structures to allow these kinds of financial engineering to be brought to their full extent. And finally, there are the trust issues, and trust issues are about politics, and that's where I'll stop. Thank you.
Thank you very much. Next up, we've got Mr. Marek Belka from the National Bank of Poland.
Thank you. Good afternoon. Well, of course, my perspective is different, coming from a non-Euro EU country. And, well, the agenda of my presentation is the following. Let me first state that non-Euro EU countries are here to stay. And basically, Patrick told us why. But let's dwell into more detailed analysis of why do some countries in the European Union stay away from joining the Eurozone, even if, as the Czech Republic, they fully comply with the Maastricht criteria, or Poland does not at the moment, but could do it easily, or really easily. Well, so the problem here is that if you are outside of the common currency of the Eurozone, you have formal independence, although limited autonomy, because of strong economic ties with the Eurozone, Euro area. You have the right to set your own interest rates, and you have the possibility to resort to exchange rate policy, at least in theory. Well, recent experience, which is the financial globalization and general economic interdependence, show limits to this autonomy. Also, if we present our case for staying outside of the euro, we obviously tell the story of independent monetary policy, or at least partially independent monetary policy. And what we hear then is that this is an illusion, because in today's world, and especially if you are within the member of the European Union, which means that you have no right to resort to capital controls, then you cheat ourselves. You cheat yourself into being able to create your own monetary policy. You don't really decide on anything. What we are told is the following: okay, you can set your own interest rates, but if you set it well, if you, as Poland does, retain a certain positive interest rate differential between your country and your big neighbor, which is the euro area, then you have to experience, or you can experience, large inflows of capital, or inflows and outflows. Well, we are told, even if you stick staunchly to free-floating exchange rates, it does not help, because if you allow the exchange rate to fluctuate too much, then for the sake of financial stability, you basically harm your real economy. As a matter of fact, this is not even true. If you allow your exchange rates to fluctuate wildly, you undermine the financial stability of your country. Well, so basically, you cannot do a lot. If you are in a situation like yours, heavily integrated, being heavily integrated, trade-wise, finance-wise, bank-wise, all what have you, with the euro area, you are doomed. You better step in, because it's an illusion that you can retain your any sort of reasonable extent of monetary autonomy. Well, let's check. Because what I would like to tell you is that what should not work in theory works in practice. And I will show you the case of Poland. Okay. So, non-euro EU countries are here to stay. Why? Well, because we learned from the crisis. Basically, I'm going to skip it. Limited independence. The economic ties with the euro area are extremely strong. Whatever limited independence you can have, free choice of exchange rate regime, formally independent monetary policy, but liberalized capital flows, unlimited by first strong trade linkages with the euro area. 75% of our exports go to the European Union, 50% to the euro area, 25% to Germany. With the imports, it's similar, except for our imports of commodities from Russia. This is supported by large inflows of FDI. Around 85% of this stock originated from Europe. This is basically the same. The next slide basically illustrates the same phenomenon. Well, we depend so much on large inflows of FDI, or have depended on large inflows of FDI in the last 10-15 years. Ownership structure of the banks show to the same. Sorry. How can I? The pointer is, which one is the pointer? Right in the middle between the two. Okay, here is Poland. More than half of our banking sector is owned by the euro area countries, euro area financial companies. Also, the bank funding from the euro area is most important in all three cases of countries that I here look at, which is Czech Republic, Hungary, and Poland. This is about the banking sector, basically shows the same. Summary: the economic synchronization of Poland and European area is very high, and it's growing. the correlation of the cyclical components goes up to 90%. Of course, the growth rate differs because of structural differences of catching up country like Poland and developed or highly developed West European countries, but we are so immensely correlated with the euro area. Financial globalization, something that goes beyond the European integration. Well, this is well, we know that U.S. monetary policy basically shapes out what happens in credit spreads and risk premia globally. And this is something that all small open economies like ours experience daily. Opsfeld shows that exchange rates do not offset fully financial shocks. And Schoonmaker is very blunt. He says, you cannot do it. I mean, you cannot have financial stability, non-intervention in cross-border financial flows, and national control over financial supervision and regulation. Impossible. Theoretically, we are doomed. We have to join the Eurozone. Well, challenges. Challenges are, of course, maintaining both price and financial stability, continuing real convergence to the euro area, and persuading large advanced economies to take into account spillover effects of their policies. Well, the third one is really hopeless. What are the opportunities? Well, you can pursue sound macroeconomic policies so that your monetary policy is not destabilized by unsound fiscal policy. Well, this is something that we tend to forget, but this is important. Second, you have to have active macroprudential policy, something that we have discovered pretty recently. We don't understand it fully, but it works, again, in practice rather than in theory. And also, which is important, is we should enhance international liquidity supports. In the case of our country, in the case of Poland, we are banging the door of ECB unsuccessfully for establishing a swap line between the euro and Polish currency, the zloty. Okay, but then let's have a short look at Poland. Substantial capital inflows. You know, throughout the whole period, we had substantial capital inflows, which have now, let's say, been mitigated. So this is something that you would expect. Interest rate disparity, it's attractive to invest in Polish treasury bonds, basically, catching up country with relatively high growth dynamics. It's relatively attractive to invest in, let's say, productive capacities. Well, can we reconcile this with exchange rate stability or exchange rate, well, sort of limited volatility? Well, if you look at the euro to Polish zloty rate, this is this. Okay, it's pretty volatile. However, the volatility has diminished. The 3 months implied volatility is now going down, you may say, well, that's the reflection of the global situation. But I think we have contributed to this by our foreign reserve management policy, or foreign reserve accumulation policy, / direct interventions on the market. We do it very rarely, occasionally, but we are deeply convinced that it has helped stem some, let's say, sprees on the market since 2011. As a matter of fact, we have started this here. We didn't like these bouts of appreciation, depreciation. And I think we have smoothed over the course of exchange rate. Treasury bond yields, well, they are coming down, which is not a surprise. Everything's coming down in today's world. But let's look at the foreign investors in the Polish government debt. It went up from January 2010 to here, mid 2012, and then it's basically flat. The Warsaw Stock Exchange Index, well, this is not an asset bubble. It does not tell you about asset bubble or the Warsaw Stock Exchange. The same with housing market. Well, these are the prices throughout 2006 and 2014 in 7 big cities in Warsaw, and these are year-to-year price changes. It should make you envy, Patrick. And what about housing loans? Okay, we had this period of exuberance here. It's not only about the rate of growth of mortgage credit, but also about the phenomenon of foreign exchange housing loans. It's a typical carry trade that some other countries in the region suffered from, but also Spain, Austria. Well, since 2009, first we have basically killed the foreign exchange mortgage loans. Now we are in the negative with them, so they are being repaid, and nobody is getting foreign exchange loans. The zloty-denominated mortgage loans are basically growing healthily, but at a decelerating rate. All in all, the total monthly increases are now about 6%, and it's very, very stable. Well, what does it mean? Opswell Schoonmaker tell us basically that it's impossible to prevent financial stability, to prevent asset bubbles, to keep a relatively stable exchange rate, if you want to use it as a first line of defense against capital inflows. And of course, I haven't mentioned the inflation targeting, which is implemented quite well, as a matter of fact, very unsuccessfully now, because the inflation rate is now minus 0.6, which is clearly not our inflation target. So what happened really? You cannot do anything, and you still manage to keep things basically in place. I call it a strategy of leaning against the wind, which means that you have to try to find a middle ground between an interest rate which is low enough not to attract too much carry trade, and high enough not to destabilize your domestic saver, your domestic savings behavior, investment behavior. Well, it's good to have floating exchange rate. All fixers in the European Union, like the Baltic states and Bulgaria, have already joined the euro area or would like to. So it's good to have a floating exchange rate because it raises the perception of risk. But also it's good to show the flag on the foreign exchange market from time to time, so that the short-time investors, call it speculators, don't live in a world when there is no risk, so to say. Macroprudential policy is also quite important. Of course, we are only starting to experiment with it, but some of those experiments are successful. We basically persuaded the banks to drop the idea of foreign exchange mortgage loans, and it worked without any drastic measures. Now we are putting some more solid macroprudential instruments to stem the possibility of asset bubble on the real estate market in the coming years. So, well, the French are said to say that if something does not work in theory, don't be too confident that if something works in practice, it will survive. Maybe they are right, but for the time being, we have a very good argument of staying outside of the Eurozone. We keep our limited monetary autonomy quite successfully. Thank you.
Thank you very much. Now we've got Lubomír Lízal from the Czech National Bank.
Yeah, thank you. Good afternoon, everybody. It's a pleasure to be here, and I hope it wasn't the basic intention of the organizers to have two non-EU members against one, non-EMU members against one, just to have the right votes. And also one of the things which is a problem that I should mention at the very beginning, the central bankers should be somehow transparent and predictable. On the other hand, they should somehow surprise the markets, maybe also surprise the audience. So for me, it was being the third in the line might be somehow problematic, not to be repeating something which was already told. However, I might have some details to illustrate Marek's views as well as some views on the monetary union issues. Basically, I will start basically with the title of the session, which is about basically a stable financial system. And one of the steps that it's these days selling to the public, that yes, this is one of the steps that will bring us the financial stability is the banking union. Here I have some thoughts about the banking union, which actually is more relative, that whether it's good or bad depends whether you are in or out. And your position being in is different, and being out means also that you think also differently about the banking union. Last but not least, and this is something which is related to the Marek's thought about joining or not joining the eurozone. Actually, once you are in the eurozone, you have to have the banking union. If you are out, you have the option to choose. Not surprisingly, all the countries, except one exception, are choosing not to join the banking union if they are out of the eurozone. And I think that if you think about the benefits that the banking union should bring, then it's clear that it should help the states that are with more fragile financial systems. Going back to the situation in the Czech Republic, we don't have such a problem. So some of the eligible benefits, we know it, they are there, but they are not for us, since basically we do not have that problems. One of the eligible benefits is the effective transmission of monetary policy. Well, I would slightly disagree with that, since at the end I will actually show that being a small economy, open economy, you can do a lot with the monetary policy anyway. The other thing is that talking about the Czech Republic, basically the situation is quite different from other countries, namely in a sense that although we had a long and protracted recession currently, the problems were not revealing themselves in a financial sector. Basically, the Czech financial sector is healthy, and it has been actually providing liquidity outside the Czech Republic. So this is one of the points which is quite different, and it's also slightly different from the other Central European countries. The other thing is that being out of the eurozone, for me, the banking union is really good, since it helps to solve the issues in the eurozone. Doesn't mean that it's good for the euro members, it's good for the non-euro members. So exactly as the point that the banking union was created to actually serve as semi-lender of the last resort, to basically replace that deficiency of the banking union. I will skip some of these histories to have some thoughts, but let me think from broader perspective about the banking union and all the safeguards that are planted in and that we believe that will help for the future to prevent any banking crisis. Just if you look at the numbers, then actually the numbers are on a slide. And if you think about the size of the resolution funds or the mechanisms that should help to resolve the financial crisis, then you actually realize that the numbers are below the rounding error of the other numbers. So to believe that I can solve something which is of order of rounding error, a problem of that magnitude, is, well, it's an illusion. I'm not saying it's not good, I'm just telling, well, you know, those funds or these mechanisms might be useful if you have a small crisis or some small problem. If you will have a real big problem, like we had, or what was in the United States, those funds will not be sufficient, and ultimately you will still need the lender of the last resort. And this is something which is a political question, and this is not solved and will not be solved by the banking union. So this is one of the major problems that is here. I will also mention one other feature, and I will return to it later in my presentation from different perspective. And this is that the banking union should help to bring to basically eliminate the vicious circle between the banking sector and the sovereigns. Yes, this is something which helps, and for the time being, it has put this problem aside. It doesn't mean that the problem will not return in the future. And this is just to show that actually share of the government bonds on the balance sheet of the banks is steadily growing. So actually, if I'm creating a new regulation that is saying, well, you should have more capital or more reserves, but the governmental bonds are riskless, the banks are hoarding it. But as we have seen in our crisis, this is not true. The bank bonds were not really riskless. And this is, and by the historical standards, we can see that both the private credit and the public credit are somehow on high levels. The large, big numbers were during the war times. So this is one of the things that should somehow alert us, thinking about the public debts that are outstanding. We have seen those. Well, actually, majority of the people here were not here when these debts were that high. So it's a completely different generation. Yet those debts, as you can see, were repaid. Partly repaid, partly the economies were outgrowing. So far, and I will just tackle it from a side, there have been no discussion about risks from the outside. And I will just mention that we have lived in times when the geopolitical risks were not mentioned. These days, they are starting to be mentioned. And so far, I would say, if the situation is not escalated, it's not a real problem. Of course, it's a problem of a significant magnitude, but it's somehow different by the territory. Of course, the Baltic countries or the countries that had linkages with Russia and they are on east, they would be hit much more severely than the other countries. On the other hand, I will skip these numbers. This is not a real threat yet. Banking union and the point that I was trying to also make for the financial stability is that if you are staying out of banking union, your responsibility is to maintain the stability of the financial sector as a central bank or as a regulator. It might be different. However, Czech Republic is, and it was already visible on a slide that has shown Marek, Belka, that Czech Republic, virtually all the banks in the Czech Republic are foreignly owned. So, and majority of the owners is from the Eurozone. So in that case, you have a banking sector which is Eurozone owned. And in that case, your home host issue is the real important. And so far, the situation is in such a way that all the banks are daughters. They are not branches of the outside banks. So in a sense, the local regulator can exercise the regulatory powers. As a funny story, actually, last year they have been changed that the UniCredit, they have changed their Slovak daughter into the subsidiary of a Czech bank. So actually, the non-euro country is responsible for bank supervision in euro countries. So it's just as a funny thing. But the problem that we see in home host issues is that since we have a healthy banking sector, virtually we had no banking crisis, and the banks were providing the liquidities to the mother banks, we really see it as a threat that in case the domestic regulator would be prevented in the banking union from stopping the exposures to foreign countries, that actually the Czech deposits will be siphoned out to follow the others, let's say, failing banks. So this is something which is there as a risk, and of course it's also a political risk. We should not really forget about it. So for us, having a healthy banking sector and being also in some sort of flat with liquidity, for us it's not really attractive to join the banking union. Since the banking union is the condition necessary for the Eurozone accession, then of course you have another no on Marek's list, actually, which he wasn't mentioning. So this is the on a pros, on a cons. Well, of course there might be some benefits of the banking unions, but of course I have mentioned we will not at this current state probably benefit from those. So it's not really attractive from the regulatory standpoint. Financial stability and macroprudential rules, some of them were already mentioned, and this is really trying to somehow increase the stability of the financial sector, irrespective whether you are in a eurozone or not. And in this respect, I would say that the macroprudential policies can help, of course, and I will show that what we have done in the meantime to actually somehow increase the resilience of the Czech financial sector, although the sector is still, I would say, quite resilient. We have here are the lists of what's intended in the macroprudential and what you can do. Here I would mention just a couple examples of what we have done so far. We have introduced buffers already, the loss absorbing capacities. Actually, we have the capital conservation buffer, which is already in present as at the level of 2.5%. In addition, also the CRT4 has allowed us to have requirements of the banks of a systemic importance. Here are the 4 banks that actually had the requirements to have additional capital. And although there was a derogation, derogation period in which you can postpone, since the banks were healthy and they had already the capital in, so it wasn't for us any reason to postpone the regulation, and we have implemented it from the beginning when it was possible. Also, to systemic risk buffers, and those are going to be reviewed, but here we do not that much do anything. Also, the countercyclical buffers, if you are at the recession, there is no surprise that the buffer is set at 0 level at the current time. So, one of the things which might be a problem for the converging economies or for the non-euro member countries is that if you assume that there is real convergence, that those countries should somehow grow faster than the eurozone because of the catch-up process. In that case, of course, you might expect that they will have higher growth of the debt than the other countries. So this is something which is based in a criteria that should be evaluated, and in that case, those criteria should be more merit-based rather than just a simple average checking as it with other criteria in this situation. Now, stress testing. Historically, the Czech Republic has experienced banking crisis in the 90s, and it has somehow led us to stress testing before it was adopted on the European level, so we have done a lot of stress tests. Typically, what we do in a stress testing is that we have some sort of scenario which is really adverse, which is unlikely but probable, in a sense that there is small probability that could happen. The latest scenario which we had implied on evaluation of the Czech banking sector was the scenario of Europe in deflation. Actually, when we would have a protracted period of low or deflation in Europe, which would then transfer into a negative scenario of yet another recession. From macroeconomic point from the policy stand, monetary policy point, this is a real nightmare. From a fiscal stability, at least the scenario showed us that the results will not be that bad. Here you can see that the scenario leads to really deflation, that it leads to basically a protected period of low interest rates and enormous increase in unemployment. Here are the results on a financial sector, on a banking sector. you can see that, and this is the first graph on the top left, that actually the Czech banking sector will be able to absorb of such a crisis with just minor addition of the capital. So this is something which sort of leads us to believe that even though the future might not be that bright, that you might have some problems, those problems should not lead to the financial instability in the Czech Republic. Here I have some comparison of our test with the IBA stress testing. You can see that in general our stress tests are somehow more strict, that we are suppose more adverse scenarios in many of the elements. The only element in which we do significantly differ from the European view is the effect of the FX loans, of the foreign denominated loans. And the reason is that in the Czech Republic there are almost none. And if they are used as a natural hedge against income in Europe. And now comes the surprise from the central banker that during the action that should be there. And I would focus on a debate on the level of the public debt, whether it's threat to the stability or not. And here I have just a summary of various results. And all the results, you might disagree with the numbers sometimes. I have also mentioning the Reinhard Rogov. But the results, no matter on the methodology, they are always telling the same story. The multipliers are getting lower with increased level of debt. So they are giving a different story when the break point is, but at least you should rely on the fact that probably they are right. If everything is getting the same result, probably there is some merit to it. And is it a threat for the future? Well, we have seen that the current financial crisis had led to increase of public debt to such levels that were actually threatening the financial stability. So, and here I have a different figure. Here I have a calculation of implicit debts of various countries, which actually means not taking the explicit debt of the public sector, of the private sector that you know, but also calculating the implicit debt, which actually means looking at the promised benefits from the social system, promised benefits from the pension system, the expected cost of the healthcare in the future, if the expected lifetime is as it is. And you can see that actually there are a couple sources of those results, but they are getting the same answer as it was with the fiscal multipliers. That those obligations are much larger, typically, than the explicit obligations. And what I really see as a problem for the future is that if those implicit debts become explicit, then we have real problem, not with the financial stability, but we might also have a problem with the monetary policy, being able to have a monetary policy set up for situation that is suitable for such levels, and this is the reason. These days we have a problem with low inflation, and if the inflation is too low, then of course the debts are becoming too dear, and might be threatening the financial stability. The Czech Republic was in a really bad situation last year. We had been envisaging the inflation close to -1 plus something, so actually close to the Greece and Bulgaria in that region. So, and with interest rates at zero, we have been in a difficult position. So actually we have adopted the Swedish approach, not of the Swedish central bank, but the member of the Swedish central bank, Svensson has suggested that in case you have zero interest rates and a threat of deflation, the exchange rate might serve as an anchor of inflation expectation, and by commitment on the exchange rate, you might increase the inflation. And actually, this is something which has happened. Finally, as a conclusion, I would say that the small open economies that are close to the Eurozone might have problems setting really independent monetary policy, but in a case of bad times, if you use different tools, you might do a lot, and it might be really, I would say, beneficial to have the option to really use your own monetary policy. So I would end here. Thank you.
Right. Thank you. We're a bit behind schedule, but we've got about half an hour for questions. So if you have any questions, raise your hand. And I'd just like to ask you to please identify yourself first and just keep them short and to the point so we can get through them. Anyway,
I like this.
why not? I'm going to use my position as moderator and ask the first question, but then I'll open the floor to the rest of you. My question is just directed to all three of you. I guess Mr. Lízal went into it a bit more, but I'd just like to know what you consider to be the sort of biggest source of risk to the financial system right now. I mean, you all spoke or referred to inflation at some point, low levels of inflation or even potential deflation. So I'd be really interested to hear what you have to say on that. And just a mini follow-up for Mr. Honohan, given that he is our Eurozone representative, how likely do you think that it is that the ECB will soon take sort of further measures to address this issue, and what could they look like? Thank you.
Γεια σας. Να υποβάλω την πρώτη ερώτηση, παρακαλώ.
Συγγνώμη, δεν σας βλέπω. Μόλις τους ρώτησα μία ερώτηση εγώ, να περιμένουμε να απαντήσουν και μετά να το γυρίσουμε στο κοινό.
Ευχαριστώ πολύ, συγγνώμη.
Okay, no problem. Okay, go on. You can answer my question first, and then we'll switch to the audience.
Well, I really think that the projected period of low inflation can be a real problem and over deflation, and I think that part of that is historically, if I look at the countries that have chosen the target below the 2%, there are those that have a problem with stagnating growth and deflation. You know, it's really difficult to say what's the rule of thumb, where the border is, and I think this is the discussion that was here, also about how to measure the inflation, whether the harmonized index that is used by the ECB, whether it's the right one. But microprudential rules might help it, but you know, I would really stick to the fact. Well, if it works, then well, it probably works for some reason. We might not understand the reason well, but at least we know where the limits of functioning and non-functioning are, and probably it's not too good to fiddle with just trying to figure out whether the boundary is really 2 or 1.8. I would rather not do that.
I'm always looking for risks everywhere, so I don't like to rank them as which is most important. A number of risks have been brought under better control over recent times. The comprehensive assessment, especially the part that's the asset quality review, which digs into the banks, not just the bank's balance sheets, but into their loan portfolios, and has a second pair of eyes looking at pulling out thousands and thousands of loan documents and saying, wait a minute, you've only provisioned this at 5%, this is very weak, should be 20%. All of that work is done, and I think it underpins a better confidence. Confidence is the important thing, but confidence in various things. Confidence in the bank's balance sheets. Confidence that inflation in the euro area is going to get back up to the target area, and it will, and you know, step by step. We have meetings once a month, but it's going to be once every 6 weeks. You want to know what we're going to do next? I'm not going to tell you, but we've done a lot of things. Mario Draghi made another speech today. I think you've got to believe that we have things we can do. We know some of them, that they're widely discussed, and we will do what is necessary. That will get the inflation rate up. But obviously, the crucial thing is growth, and as one of my colleagues in the ECB Governing Council emphasised a few days ago, of course, growth has been weak, and we can't deny that. And there are challenges and headwinds to growth, but we have to keep pulling all the levers to get growth back into an upward trend, which will underpin the lowering of the debt overhang, which I've been speaking about, and it's part of the whole agenda. So growth, and that means employment growth, and the turnaround in the Greek economy. And there's an awful lot of headroom. There's an awful long way for Greece that Greece can and will grow. But it's not just Greece, it's the whole of the European economy.
Okay, let's go to questions from the audience. The gentleman over there.
Thanks very much. Emilio Sougoulias from the University of Edinburgh. First questions for their excellencies from the non-Eurozone central banks. I fully understand why you want to avoid joining the Eurozone, because you don't want to become secondary issuers. You don't want to have as much control on sovereign debt interest rates as Tuscany has or Scotland. On the other hand, I'm a bit confused. How, without being part of the European Banking Union, you can apply your macroprudential levers in an economy that is dominated by foreign banks and that is an inflation importer from the larger trade area, which is the single currency area, without, hopefully to be avoided, restrictions on short-term rates. Of course, there is the proposal of subsidiarization, but that's, of course, in gross violation of the internal market. First, the critical question. I'm not sure why you think Padre entails moral hazard, because Padre may be inadequate because the senior edge income that the ECB generates, which, as I said in my presentation, is rather uncertain in an environment where money creation also involves short-term claims generated by shadow banking entities. But why Padre generates a moral hazard? And even more, why a proposal like that made by the first speaker in today's conference, that 60% of the debt should be mutualized, and whatever is the interest rate differential, the interest rate subsidy that the deficit countries gain should be taken from their senior edge entitlements or the overall ECB profit. Why that would involve any kind of moral hazard? The second thing I would like to ask you is a little bit more personal, but as a neighbor, I have to admit, coming from Edinburgh, you're being watched closely and admired grossly. And the adjustment that you have, and admired greatly, as a matter of fact, and very genuinely. And the adjustment that you have implemented is nothing but monumental. Is the personality and the standing and the respect that the central bank governor enjoys from the government, the stakeholders, including the unions, and the markets, one of issues of cardinal importance for adjustment? I would fully understand if you don't answer the second question.
Okay, let's deal with this question to non-Euro countries. First, well, I truly believe that macroprudential policy should not be centralized. I think this is one of the weaknesses or of the mistakes of the banking union. Well, it remains to be seen how it will be implemented, but you know, asset bubbles these kinds of imbalances happen locally, or even nationally at the best, or at worst. So they should be treated by national macroprudential authorities. So that's to start with. And then second, how can we hope in the situation when our banking sector is so internationalized to be efficient? Well, first, all medium-sized and big banks by Polish standards, which are microbanks by French standards, say. All banks are subsidiaries and not branches. The last branch of significant size was owned by a Greek bank, EFG, which we pushed them to sell to some other bank. Second, all major banks are publicly listed. This makes it for us quite easy for our supervision to exert due pressure if it's needed on them. As a matter of fact, when I asked my colleagues from commercial banks in Poland whether they would like us Poland, to join the banking union, well, they showed some weakness or sincerity, and they told me, of course, because we would get rid of those bloody bastards from the Polish supervision. Which, in fact, is a very good argument for us not to join the banking union.
Yeah, I would probably add two more observations. One is that there was the Czech introduction to the negotiation, which says that it should not be encouraged to change the subsidiaries to branches, which was one of the reasons that, and there was good reason for us historical when we seen something. On the other hand, and this is just to say that probably they will stay as subsidiaries, not branches. If they are subsidiaries, then of course the management is legally responsible and is responsible for the local actions, no matter what the mother says. So of course, then you have also the threat of the punishment, which starts to think them differently, and we have actually seen some of the other issues saying, well, we would love to do whatever the mother company wants, but the local regulator is strict, and we can't do these things. And they use it as an excuse, as a good excuse, and they like these excuses. So, of course, then means that there is less limit on, less pressure on their side to really change it as well. But last not least, I would have a practical observation. Practical observation is that if the bank fails, then if it's branch, then you deal with the foreign entity for reimbursement of the deposits. And if a large bank, systemic, would change into the branch, I would say that the ordinary depositors would flood. Basically just for the fact that in case something happens, should I go to Vienna, should I go to Brussels, or where it is? And I think that this is the natural solution of that.
So maybe I address the Padre question. So Padre proposal is something like this. ECB should buy all the government paper, or a lot of, not all, half of the government paper all over Europe, and it should basically cancel that stuff, and the loss of, so the governments don't have to pay interest on them, on these debts, but the ECB then will charge over a period of time the interest that would have been paid against the seigniorage. So the national central banks of the different countries wouldn't get that much seigniorage out of it. So the question specifically is, why does this proposal entail moral hazard? And so I explain why people will worry about moral hazard. I'm not presenting my own view on this thing, but just why do people think there's moral hazard? Because by effectively reducing the debt of the countries, you can start again. And we've seen this in developing countries. You have wipeout of debt for some sort of forgiveness, and then what happens? A new government comes in and says, oh, look, we have no debt, we can borrow a lot from the markets. So there's this risk of allowing the debt to balloon out again. So that's one dimension to it. Another dimension, I would say, in the attitude of people who would be very suspicious and doubtful about a scheme like this. They say, oh, seigniorage, it's very complicated stuff, it's smoke and mirrors, it has to do with fancy money, and in there somewhere there are going to be some smart people trying to grab resources that ultimately will be monetary financing. So it'll be a vague idea that this would open the door to a kind of behavior that would transfer. Role of the central bank. Let me just say, because it was Lubomír says he needs to have a surprise. And I think that's true, always you need to have little bits of surprise. But the role of the surprise in central banking has diminished over time. I mean, 20, 30 years ago, that was the whole thing. You wanted to surprise the market so that you could get some control over the markets. And now we adopt an entirely different view, which is to say the markets need to know what we're going to do so that they know we're going to get to 2%, and so they will move everything towards in the direction that they think that we will go, so the consistency of messaging. Now, this is also relevant in a crisis for the positioning of the central bank vis-a-vis the general public, because a central bank works in an environment of public confidence. And I think the crucial thing is to communicate to the general public as well as to the markets in terms of what you are doing and why you are doing it.
Okay, yes. Can I just say, I see two questions. We can start with the gentleman over here, but maybe ask the second one as well, and then we can, because we don't have very much time, and they can reply to both. You go, ξεκινήστε.
Ήθελα να υποβάλω μια ερώτηση στον κύριο Πατρίκ, τον κύριο Διοικητή. Κύριε Διοικητά, άκουσα με πολύ ενδιαφέρον την...
Mike, the translator cannot hear you because no mic, so maybe you have to turn it on.
It seems like it is on. Is it working for you?
Κύριε Διοικητά, άκουσα με μεγάλη προσοχή την ομιλία σας και θέλω να κάνω κάποιες επισημάνσεις και να θέσω ένα τελικό μου ερώτημα προς εσάς.
You have to translate it.
Okay. Συγγνώμη, απλά δεν λειτουργεί καλά η μετάφραση. Θέλετε να μεταφράσω εγώ την ερώτησή σας?
Ναι, θα χρησιμοποιήσω ελληνικά για λόγους μνημονιακούς. Θέλω να τονίσω στον κύριο Διοικητή ότι είμαστε περιφερειακοί λαοί η Ιρλανδία και η Ελλάδα, καθώς και η Πορτογαλία, η Ισπανία και η Ιταλία. Περιφερειακοί λαοί του ευρώ. Η χώρα σας, κύριε Διοικητά, ήταν η κέλτικη τίγρη και σήμερα είναι μια πεινασμένη γάτα. Επισκέφτηκα τις προάλλες το Δουβλίνο και είδα συνοικίες του Δουβλίνο και του Λίμερικ με συσίτια και φτώχεια. Την αντίστοιχη εικόνα τη βλέπουμε λίγα χιλιόμετρα από το Μέγαρο Μουσικής σε συνοικίες των Αθηνών. Δήμους, συσίτια, φτώχεια, επιχειρήσεις διωγμένες από φόρους και χρέη. Τα μνημόνια, κύριε Διοικητά, είναι τα ίδια στις περιφερειακές οικονομίες του Euro, στις χώρες που προανέφερα. Τα μνημόνια, κύριε Διοικητά, είναι θνησινογενή και βαθαίνουν ακόμη την ύφεση και αυξάνουν την ανεργία. Τα μνημόνια, κύριε Διοικητά, δεν ανταποκρίνονται ούτε στις προβλέψεις της στρατηγικής Ευρώπη 2020. Και επίσης, τα μνημόνια παραβιάζουν την Ευρωπαϊκή Συνθήκη και ειδικά τα άρθρα 2 και 9. Μας αναφέρατε κάποια παραδείγματα, κύριε Διοικητά, μόνο για την Αμερική, όχι για την Ευρώπη, για την ανάπτυξη. Και θέλω να σας πω ότι... Να σας ρωτήσω τώρα, να θέσω τα τελικά μου ερωτήματα και να κλείσω την τοποθέτησή μου. Ποιος είναι ο ρόλος της Ευρωπαϊκής Ένωσης? Δηλαδή, γιατί η Ευρωπαϊκή Ένωση δεν δανείζει χρήματα στις περιφερειακές οικονομίες του Euro? Τι γίνεται εδώ? Δηλαδή, έχουμε μπει στο τροχοπέδι του Μάστριχ και δεν έχουμε καμία εναλλακτική. Δυστυχώς, η συνθήκη του Μάστριχ μας έχει τροχοπέδι. Ο σκληρός πυρήνας του ευρώ είναι αυτός ο οποίος κάνει κουμάντο και εμείς εδώ τι θα κάνουμε? Τα πράγματα είναι τραγικά και σε εσάς και στα κράτη που προανέφερα. Εσείς έχετε μια ελπίδα να γίνετε η 51η πολιτεία της Αμερικής, σε περίπτωση που θέλετε για να φύγετε. Ο λαός σας είναι πολύ σοβαρός και έχει το θάρρος. Εμείς εδώ όμως δεν μπορούμε. Και θα κλείσω να θέσω ένα ερώτημα σε όλους σας. Τελικά, η εσωτερική υποτίμηση αυτών των λαών, των περιφερειακών, είναι εφικτή να γίνει για να βγούμε από την ύφεση και να γίνει και μια διαγραφή του χρέους, γιατί μιλάμε για ένα επιτόκιο 5,8, δεν είναι και flat το επιτόκιο, και να πω ότι μιλήσατε για το πλαφόν του 60%. Έτσι δεν είναι? Μιλήσατε για το πλαφόν του χρέους κάθε κράτους 60%. Κύριε Διοικητά, η Ισπανία δεν έχει υπερβεί το δημόσιο χρέος ούτε το 50% και εντούτοις η Ευρωπαϊκή Ένωση θέλει να τη βάλει στο μηχανισμό υποστήριξης. Γιατί όλα αυτά? Δεν μπορώ να καταλάβω, και έτσι έχω εντρυφήσει τα μνημόνια τεχνοκρατικά. Ο ρόλος της Ευρωπαϊκής Ένωσης είναι περίεργος για αυτά τα κράτη τα οποία σας ανέφερα. Να σας ευχαριστήσω πολύ για την τοποθέτησή σας και να πω στους κυρίους από την Πολωνία και την Τσεχία, οι οικονομίες είναι καλές, ας σκεφτείτε, κύριοι, την ένταξή σας στο Euro. Είναι δύσκολη υπόθεση. Εμείς εδώ λιμοκτονούμε, υποφέρουμε και δεν υπάρχει προοπτική βιώσιμης ανάπτυξης. Σας ευχαριστώ πολύ για τον χρόνο τον οποίο μου έχετε διαθέσει.
Shall we just take a second question as well, because we don't have very much time? I think you had one over there. Just over there.
Yes, I'm George Georgopoulos from Reuters News in Athens, and I would like to ask Governor Honohan on his view after President Draghi's comments earlier today, which basically opened the door wider to quantitative easing, and whether the upcoming December's policy meeting at the ECB would be, in your view, too early or just about right to launch the measures? Thank you.
So let me deal with the first question, which I mean I have very much sympathy with the perspective that's presented. I think the situation in the peripheral countries is extremely weak and difficult. Many people very, very badly hit by everything that has happened. It's a huge topic, but I want to focus in on one aspect which you address, which is it's the memorandum, as you call it, and the program, as we call it. From the perspective of a policymaker of a small peripheral country, I actually do not see those programs, those policy programs, the program that we adopted in Ireland anyway. I will not speak about the Greek program. I don't know enough about it. When we went to the IMF and to the European lending entities, to the Troika, in November of 2010, we went because the government was in a large borrowing situation and shut out of the financial markets. Without some lending assistance from these official entities, the government would have had to collapse its spending program, increase taxes, but definitely reduce enormously the spending in a way that's more or less unimaginable. We needed that lending program. We knew that it can't last for a long time. It's only going to be a block of money for a certain period of time, and then you're on your own again. The adjustment in the public finances had to occur. The adjustment was smaller and slower than it would have had to be if we had not made those adjustments. Now, in broad outline, the adjustments would have had to be made. The exact details of how they were done by the government, the choices of particular taxes, particular spending programs, this I won't speak to. But an adjustment of that amount had to be done because the market would not lend us money, but the official lenders would lend us some money. So I don't think we should blame, at least from Ireland's point of view, and I don't think we should blame the program for the problem. The program is a partial channel to escape from the problem that was earlier created. Could more have been done? Could we have got more assistance, more generous assistance? We got assistance. Some of the interest rate is very low. Some of the interest rate from the IMF is not low, but that's why the Irish government is repaying it in advance. Some of the periods of repayment are quite long, 15 years from the Europeans. Could it have been more? Is the European Union, is the euro area more of a solidarity than that? This is a political question which I cannot answer. But I think it is important not to blame, at least as I see it in the Irish case, and not to blame the structure of the programme for the poverty and for the damage to the economy. This was caused by the forces that created the over-indebtedness. And we can go back and ask about those too, but the afternoon isn't long enough. But I do have an awful lot of sympathy. We are not in a good position, neither Greece nor Ireland. The recovery has started in both places. We're more advanced in Ireland, and we didn't dip as far down. But as the slide I showed earlier on, has been a very deep collapse, and we're well below where we could be and should be and will be in due course. I will not, I'm afraid, offer Reuters a projection going ahead of Mario Draghi and upstaging Mario Draghi in his speech today. It's already hit the front pages of the newspapers. My small voice would not, I think, add any depth or luster to his remarks.
It looks like we have time for one more question if anyone wants to ask. Oh, there you go, over there.
Governor Honohan, again for you. Vasilis Karamanis with Bloomberg News. I will have to keep on asking about Draghi. President today stated after his concerns on inflation levels and so on, that in Asia, especially in Japan, and the US, QE brought about big FX depreciation, and the euro stumble against the USD is continuing. Do you see further depreciation as necessary for the ECB to battle deflationary pressures? And if so, could it maybe help even avoiding full-blown QE through outright purchases of sovereign debt?
Sometimes people say, well, why, you make a lot of speeches, but they're mostly about the Irish economy or about structural issues of financial stability, and they're never about monetary policy in Europe. Why don't you speak more about monetary policy? And the reason is this. I come from an English-speaking country, and everybody in my audience, local audience, can read the broadly English language global media. So sometimes I suggest to Mario Draghi a word here or there in some of his statements or his public statements, so I can have my influence there. But when Mario Draghi speaks for the ECB on monetary policy, his voice is the absolute one. Maybe Yanis Stornaris will come here and speak in Greek to a Greek audience and give an explanation, and that will be helpful for the Greek audience because some may not be reading what Mario Draghi is saying in Italian or in English. So I never gloss on Mario Draghi. There is one spokesman for monetary policy, and that's Mario Draghi. That's why I don't speak on monetary policy, because everything I want to say has been said perfectly by Mario Draghi, sometimes with language crafted by myself.
Right, if there are no more pressing questions, oh, sorry, okay. Please just keep it short, and yeah. Last one.
Hi, I'm Robert Sweeney, University of Leeds. I just have one general comment and a quick question to Patrick Honohan. It seems that a lot of cross-border capital flows emanate from banks' borrowing needs. They borrow in the unsecured market or the repo market. So that being the case, it would appear that if you put domestic restrictions on lending, that this will have quite serious capital flows implications. And that sort of ties in with the sort of new impossible financial trilemma that Marek outlined. And then question at Patrick is, do you think that any of the new restrictions that Ireland recently implemented will have capital flows implications?
So this question refers to a macroprudential framework which we're proposing to introduce in Ireland on loan-to-value ceilings and loan-to-income ceilings for residential mortgages, because we want to have this in place in case of an incipient sort of bubble running away again. House prices in Dublin have bounced back by 38% in 16 months. Now they're still well below, 40-something% below the peak, so we're not in a mispriced market by any means. But we're putting those in place. Actually, those measures will apply to any regulated lender in the Irish economy, whether they're coming from abroad or from domestic financial sources. So it will not actually, I think, induce a response that, oh, the Irish banks can't lend now, so people will borrow indirectly from a foreign lender coming in. Of course, if such measures applied to lending to large corporations, then there wouldn't be these consumer protection type of, and you could imagine a large corporation borrowing across border. It has been a reason in the past, in the pre-crisis era, a reason for not coming down and restraining domestic banks. They'd lose market share to foreign banks. My view on this is too bad. If there were such effects, I would not be interested in protecting a profit flow of a domestic banking system. Banks and financial institutions are there to serve the economy. The economy is not there to serve the financial institutions. But in this case, I don't expect a flow response at all.
Right, I think that's it for this session. Thank you all for being here, and thank you very much to our speakers.